Hello and goodbye, everybody. It is September 20th, 2023, 8:46 a.m. I was about to say 9:20 a.m. because of the old times we used to do. And today is the day that we have been all waiting for a very long time. Look at Gator already calling me out. Late 2 weeks, 2 times this week. I'm sorry. 2 times. I'm sorry. I'm trying to get the camera adjusted. I'm late by a minute. I'm sorry about that. But I'm here. And we've got a lot to talk about. I'm here with you for the next 75 minutes in this new time slot, which I love, 8:45 to 10 a.m. And then I'll be with you again at 2:30 when the Fed officially has their FOMC meeting. I'll probably start at like 2:20, so we'll do a little pregame for 10 minutes and take some shots before Jerome crashes the market. And then we'll go from there. Today is the day that we have all been waiting for. Jerome Powell, the chair of the Federal Reserve, is going to be announcing his decision for what he wants to do with rate hikes. Either he is going to increase rate hikes, which seems unlikely. Only 1% of analysts on Wall Street believe that Jerome Powell is going to be raising rate hikes, or he's going to pause. More likely than not, we will get a pause. And today we'll be talking about all the reasons for why we're likely going to get a pause, and also some of the reasons for why the pause and the rate hike at this stage, given where U.S. debt is, given where bond yields are, which we also have to talk about, might not matter that much going into the end of the year. And also the bull case for why the market could rally to around 4,800 because of technology in particular by the end of this year. So we got a lot to talk about. We got Jerome Powell, we got the Fed, we got Instacart's IPO that happened yesterday. It's time to get into the market open. Brandon, Joshua, Brian, Gators, Mike, Ty Gordon, SJ, Joseph, John, Jason, Robert, Jay Shash, who's saying, who is Jerome? For some reason, we all know who Jerome Powell is, even though most of our friends, if we texted them a picture, would not know who Jerome Powell is. Imnab, Joseph, Hakun, Monty, Gators, Jude, Investor, Miami, Ren, Billy, Irwin, Joseph Viegas, Damian, Broccoli, Bob, Marcus, Sam, Inbound, Johnny, Dario, David, Noland, Long, Model Society. Thank you all for being here today. Jay Santiago, W. Begun, John 33, Brian. All right. Let's get into it. Jason says he is cooking breakfast while watching this, getting ready for the day. LOL. Thank you for your efforts, bro. I appreciate you. Let me know what you guys have had for breakfast. And also, we haven't done this in a while. Let me know where you are watching from. What part of the world are you in right now? Put it in the chat, and then I'll read them out to see where we are all watching from right now. All right. So first thing I want to talk about, we obviously have a lot of stuff to talk about the Fed. Let's cover something very quickly, is the Instacart IPO. Instacart officially did go public yesterday under the ticker symbol CART. And as a result of them going public, they had a little bit of a run-up. Instacart's IPO, wow, it's already down 5%. Okay, so it was up 40% at one point. I believe at $39. So we saw Instacart go from $31 to $39, nice little 40% gain. If you had gotten shares allocated from either SoFi or Robinhood, which were two of the more retail-friendly apps underwriting the IPO, you were up 40% in really a matter of minutes. And if you sold, you had a 40% gain. If you did not sell, the stock currently is at $32.01. It IPO'd at $31. It's down 5% from where it ended yesterday, up 12% at $33, which means you are up $1 on your IPO. And more likely than not, it's not going to be at the same $31 price. I have had a bad feeling about Instacart all week. I just did not feel like this was a company. Like, if you just compare momentum around the ARM IPO and the future of AI resting on ARM, at least that's how being pitched by the CEO. What was the bull case for Instacart? Groceries. And it's like the overarching necessity to feel like this is part of the future just wasn't there. Now, Instacart might be a great investment years from now. It might be like a really good thing. It's just on IPO day, you buy something that really has power to stay for the future because you think it's just so undervalued. And even ARM right now, 54.72, down about 1% in the pre-markets, only barely up from its $51 price range. It's up $3, which is not too bad, but it was at 64 at one point. So if you got Instacart, I hope you sold. I hope you did not really hold on to this one unless you really believe in its future, because it was obvious that it was coming down. The VCs were getting liquidity. Everyone was letting liquidity, founders, insiders, retail, it was going to end up pulling the bag on this one. Now, the other thing about Instacart that's also really interesting is that the unique thing about their business is the advertising revenue, which is what has led them to a lot of high margins, but a lot of the grocery sales are not that high margin. So they were able to show that they're growing significantly in a unique vertical. The problem is if that vertical doesn't grow, you're left with a grocery business. Like if advertising doesn't grow, that's going to be one of the problems. And I think a lot of investors didn't take into account that has to be the catalyst for this to get a tech multiple, not just being a tech platform that connects grocery stores with shoppers, because that doesn't have the best margins in the world. So Instacart IPO, look, it was successful, but we'll see if it comes down today with the rest of the market. If Jerome Powell takes down a lot of these stocks, then Instacart is going to be no exception to what's going on. S&P 500 at 444 and the pre-market's up 0.33%. The market's actually green. If you look at a lot of these stocks, Palantir's green, Google's green, Amazon's green. A ton of these stocks are green right now going into the pre-market. Lucid, which hit a 52-week low yesterday, is also green. So market is seeming, at least in the pre-market, ready for Jerome Powell and what he has to say, even though they're cautiously optimistic for what is going to be said. Let's see some of the people that are here. We have Shanghai in the house, North Carolina, Australia. I love Australia so much. I love the Australian accent. I can't wait to visit Australia one day. Dallas, Tejas, of course, Germany, Zimbabwe. That's amazing. That's awesome. Malaysia, Missouri. Race is under your bed. That's a little scary. Jay Schwash has just had a double scoop sundae with extra hot fudge for breakfast. This is the problem with Americans. This is why we all have overweight and obese kids. Japan, I'm just kidding. Japan, popcorn in Arizona, Texas, Virginia, UK, North Carolina. I love it. Bristol, UK, Boston. It's so cool to see where people are from. It just reminds you the world is so big when you see stuff like that. So that's just amazing. That's awesome. Peter, thank you for the super sticker, $4.99. Thank you so much for that. Really, really appreciate it. We got Atlanta, Denmark, Singapore, Israel, Uranus, of course. I'm not UK, Mexico, Alabama. I love it. Okay, so let's get into the next thing after Instacart, which is the Federal Reserve and what they're going to be doing today. So I want to do some extensive coverage on what's going to be happening, and we'll keep going from there. Now, in order to start this coverage, I want to pull up a Twitter thread that I thought was pretty interesting yesterday. We talked about it a little bit on Finance Junkies. Didn't get that deep into the specific thread itself. But the thread, it's a clickbaity thread. That's definitely for sure. The person who wrote it is trying to fear a lot of people. And so I want to take you to the bull and bear case of what they're trying to say. But it is fascinating to see kind of the arguments that's being made here. Okay, so last night, the 10-year note, which is the 10-year Treasury bond, rose as high as 4.37%. Let me actually see where it's at right now. 10-year Treasury. Currently, so yesterday was at 4.37%, up from 2007. Right now it's at 4.34. So it's down a little bit in the pre-markets. We'll see what happens when the Fed speaks. Rates continue to rise despite a Fed rate pause expected. Why? Because the U.S. is issuing record levels of Treasury bonds to fund deficit spending. There is so much supply that it is driving bond prices lower and Treasury yields higher. Between this quarter and the next, $1.9 trillion in U.S. Treasury bonds will be issued. We are paying for deficit spending in many ways, and higher interest rates is one of them. So we have so much debt that in order to finance the debt itself, in order to create new debt for people to buy our debt, which is, the nature of Treasury bonds, we have to issue more bonds, 1.9 trillion in U.S. Treasury bonds, which means obviously yields are going to be a little bit higher on those bonds. And so this is a really interesting thing to look at. The 2-year got to the highest it was since 2006 yesterday. Right now it's at 5.071, so it's down a little bit. One of the posts, however, when we see this is interesting to me, because if we go to this account, they tweeted another thing yesterday that was really interesting in regards to banks. Okay, so right here, if we go to banks, where was this tweet? Let me actually pull it up. I know exactly where to find it. So let me pull it up. So the 10-year Treasury is up heavily, right? And the 2-year and 10-year are still inverted because of the fact that we've had bond prices continue to, we've had yields continue to go higher given where bonds are at, or given where people think U.S. debt is at. Now, one would beg the question, right? If that's the case, if the 10-year is giving you 4.3%, the 2-year is giving you 5%, wouldn't you take your money out of a bank? Why would you have your money in a bank that's giving you 0.001% if you're being able to get a ton of money from Treasury bonds? And I thought this was the case as well. Okay, so now look at this. Wells Fargo is giving you 0.15, Citibank 0.05, Chase 0.01, Bank of America 0.01, US Bank 0.01. Let me know if any of you guys bank with these banks or if you're in more high yield savings account. On bank deposits, you have 5%, money market 4.5, treasury bonds 4%, right? So obviously, if you are an individual that has a large amount of capital and want to get some level of return, keeping it in Citibank or Chase makes no sense. Well, if you take your money out of Chase and Citibank and Bank of America, that's not good for the banks, right? Because they need your money to be able to invest in it. So the deposits are continuing to flow out of banks at a historic pace with $1 trillion withdrawn over the last year. That is correct. However, if you look a little bit more at this chart, deposits in 2022 around April were at 18.2 trillion in all commercial banks. By 2023 May, it got to around 17.2 trillion. So $1 trillion did leave over the course of 2022 to 2023 out of banks into things like treasuries, money markets, etc. Definitely not really into the stock market. Some of it in the stock market, but more of it into things that were yielding 4 or 5%. However, if you look here, from 2023 April to 2023 September, it's actually gone up. Deposits have gone up in banks. And so one of the things I think this is really important to understand for the Fed FOMC meeting is if they choose to, for example, raise rates and the treasury yield spike even higher, maybe we're going to see more money leave commercial banks into money market funds, treasury yields, bonds, etc. If that doesn't happen, which 99% likely it's not going to happen, we're likely going to see a pause. We may see a further stabilization of money coming into banks. So everyone that's saying, the banks are screwed, there's going to be a bank run, there's going to be a commercial bank run, like, yes, Silicon Valley Bank was screwed because they had fundamentally mismanaged their capital and they put a lot of money into high-risk startups, which is not the best way to manage some of that money at low interest rates. And then Credit Suisse was a whole different situation that had a lot of legacy issues. But the core banks in the United States are having deposits very stable. If they're going down maybe 1 or 2% year over year, which is not as much as you would expect. And if anything, they're going up. And so it's interesting to see that context, that money is actually staying in commercial banks. People actually do have the confidence to keep their money in banks. Now, that could change. And if that changes, that would be pretty tough. But still, that's not horrible for the banking sector in and of itself. David said, my broker is getting 4.5 on cash. I've emptied my bank. So I'm the same. I've emptied my bank as well. In fact, my bank charges like a $10 a month fee if you don't have a certain minimum, Bank of America. And I pay the $10 a month fee because the return I'm getting in the stock market, at least in the positions I'm in, is worth for me to pay the $10 a month to pay that fee to not have my money in the bank. Like, I'd rather have every cent I have in some of these stocks. So, it is what it is, but there are other people that have high yield savings accounts with Capital One, American Express, etc. But general bank accounts, if I had my money just in my general checking and savings, I would be getting nothing on it. And so this is also a bull case for SoFi, right? Because SoFi is giving you 4.5% yield. Their net interest income margins are enough for them to be able to cover the cost of the yield and still be able to make a percentage on the money that's coming in when they invest it or when they give it out into where they originate different loans. And so the bull case for SoFi is really a lot of people are starting to wake up to the fact that they should not have their money in some of these bigger banks and they're putting it into smaller companies like SoFi. However, it's still a drop in the bucket, for SoFi compared to the 3.3 trillion that JP Morgan used to have. Jay Schwash says, I used to use Silicon Valley Bank. Now I use Chase. Imnop says, I bank with Bank of America. When I asked about a money market, they directed me to their investment arm, Merrill, and was able to get a self-directed account with about 5%. Yeah. And see, like, as long as they can keep you into the ecosystem, that's also something they want to be able to do. The problem is a lot of people are just leaving because, they don't want to leave. I mean, it sounds like you need to switch to SoFi. I would if they had bank accounts or business bank accounts. The problem is my business is my bank account is, I've had a consulting firm, which is like an LLC, to manage all my personal finances since 2018. So I've literally never had, well, I do have a personal checking and savings, but like, it's just, a couple hundred here and there, but like the actual money I make, I put it in there. And so I need to be able to write off expenses, et cetera, show off stuff. And SoFi, I can't do that without that business bank account. So that is one thing. If they fix immediately, I would instantaneously put my money in there. But now, so we talked about bond rates. We talked about bank deposits. What does this mean for the Fed? It seems very likely that the Fed is not going to raise rates because of what we talked about over the past couple of weeks, which is they don't have enough data to be able to determine if inflation is sticky or if inflation is not sticky. If we look at oil prices right now, we hit a high of 95.50 yesterday. Right now it's at 92.34. I have a feeling that a lot of things are going to start to normalize over the next couple of months if we get, if we get some things to fall into place. So for example, if oil can normalize at around 85 over the next month, we're going to see a decrease in CPI. If housing inventory can start to hit the market, which by the way, it is starting to hit the market, not as at aggressive of as a pace as we want, especially apartments, but it is hitting the market. If it takes a month or two for that to start decreasing CPI, that will happen. If the auto worker strike can finally be solved, used car indexes are probably not going to rebound. They're down 15% month over month. That's 7% of the CPI. If that goes down another 15% in September, then that's going to have an effect on CPI. There are some indicators that are telling us that CPI will come down due to gas prices hopefully normalizing, rents coming down, housing supply hitting the market. The Wall Street Journal just did a piece today. The title of the Wall Street Journal's piece is America's Biggest Landlords Can't Find Houses to Buy. And the whole piece talks about how the nature of inflation is causing construction to go up, labor to go up, and the very nature of supply is not there for houses. And this matches the story I told you guys on Monday when I talked to a real estate basically tycoon in New Jersey, a family friend saying like, I can't build houses fast enough. And if I list them on Zillow for $500,000 above market value, it will sell in 5 minutes. So once housing supply hits the market, hopefully that issues a little bit of relief when it comes to prices as well. And so I think my perspective is I think what the Fed believes, which is, look, there's a lot of stuff in the pipeline that should prove that inflation is not this 4%, 5% monster we think it's going to be. Yes, CPI came in at 3.7%. Yes, it was hotter than expected, but it still has a lot of data that it needs to be implemented within in order for it to cool back down. If the next CPI is at 4 or 4.1, we're in a bad situation, because then there is absolutely, we cannot have 3 consecutive months of rate hike increases and the Fed decides to not, or sorry, 3 consecutive months of CPI increases and the Fed to stay flat and not raise rates. That's going to be tough. Now, if you look at Trueflation that takes in all relative real-time data, Trueflation has 2.68%. And although Trueflation has gone up, so as you see in the low of August, we were at 2.13, and even in July, we were at 2.08. We've gone up from 2.08 in July to 2.08 in July to 2.68 in September. For the headline CPI, that translated from 3.0% to 3.7%. But if the actual data starts incorporating itself within what the Fed is looking at, which is why people like Trueflation, right? Because it's more real time. Yes, inflation has gone up. Yes, it is stickier, right? We went from 2.08 to 2.68, about 600 basis points higher when it came to Trueflation's methodology. That's still below 3%. It's still closer to the Fed's target at 2%. So the question becomes, will the Fed wait until we get to like a 2.9, 2.8 by the end of December before they decide to raise rates? Because then they'll just probably pause and it'll be normal. Or if they see one more increase or just not a significant enough of a decrease by November, will they decide at the November FOMC meeting to raise rates? Right now, the federal funds rate, I believe, is 5.25, right? What is the Fed funds rate? 5.25. Yeah, 5.25. So if we raise it to 5.5, it's going to be, is it 5.5 already? I should know this. I think it's 5.5. The point is it's high. And if we raise it again, the biggest implication for the Fed is, which is why I think they also don't want to raise it, is that banks are going to have so many hundreds of billions of loans that are in the negative in terms of paper losses when you mark them to market. All they have to do is lower interest rates once, and the banks are going to start getting momentum. Stocks are going to start getting momentum, and overall the economy is going to feel like maybe this is a place to invest because inflation is coming down, and all those losses that they have, billions and billions of dollars, and not just regional banks, Bank of America, Chase, they've got hundreds of billions of dollars of losses that they issued years ago that are now underwater because when you mark to market, the interest rates are much higher than what they issued them at. When that changes, a lot of these banks will have momentum and things will start to get better. The question simply becomes, when is the Fed going to be able to do that? And we'll see, ultimately when they decide to get there. When will Powell ruin the market? When will he speak today? 2:30. I'll be here at 2:20. And, we will cover everything that happens. UAW threatens to expand strike if talks don't yield progress soon. They've already been striking. They started striking yesterday a little bit more. We've been covering the story. There's not any new developments on that other than the fact that they're striking, and that's going to really suck for inflation if these guys continue to strike. It's just not going to get us in the right place. Does Amit think we're going to get a rat hike? I think there are definitely some rats on Wall Street, but we're not going to get a rat hike today. I think we'll be all right. It's just a question of how the market's going to react to it. Let's get a little coverage from CNBC. This analyst believes that even if the Fed raises rates one more time, will rally into the year end. And a lot of analysts are feeling this way because of technology and because of the overall fact that trillions of dollars in money market funds eventually has to come into the market to get the best return they can get.
Fractionally up higher right now ahead of the Fed decision today. So what are you watching for? What kind of impact do you think it's going to have on the markets?
Yeah, big day today. I think, to kind of just lay it out there, I do think that whatever impact it does have on the markets is sort of short-lived. It doesn't really change my view going into the end of the year unless it's a shock. So I do think that the wide expectation is that the Fed will hold today and talk about perhaps one more rate hike this year. But what's very important and what will be very interesting is to see what that median dot plot looks like. So how many more rates are actually being, thought of being priced in for the rest of the year. If it's more than one, I think the market pulls back immediately and we go back into worrying about whether or not, there will be a recession, whether or not we sort of lose that soft landing that I think we're already in now. And then the other topic is actually going to be that 100 basis points rate cut that we are thinking about for next year or within the next 18 months or so. So if that's something that is then off the table, I think the market gets spooked that perhaps the opportunities that we're hoping for will be sort of hindered by higher rates.
All right, so you're paying close attention to the Fed projections, but you're a bit of a contrarian. I think a lot of people think that the Fed's done, but you're actually looking at one, maybe even two more hikes. Is that priced in? Because right now we are seeing futures move higher. I would think that would be on the thought that the Fed might be done or might not be as hawkish as they previously were.
Yeah, well, I think that there's probably one hike priced in. I think anything beyond that is actually something that will pull the market back and sort of change the course of pricing going into the end of the year. If we get one more hike, I think that the market's on track. We rally into the end of the year. There's a lot of reason that we should have some tailwinds and momentum to see a positive S&P, NASDAQ, maybe 3 to 5% from where we are now. But if we get more than one hike, I think that'll be a little bit trickier for the market, and then I think it'll be choppy, volatile. It'll probably end a little flatter.
And one of the reasons I also think that is because earnings are going to be good. Q3 earnings should not be that bad, especially for tech stocks. So if Q3 earnings are decent, outside of Nvidia having ridiculous expectations, but in general, more of the Googles, Amazons of the world, like that's another catalyst for the S&P to kind of do fine towards the end of the year if we don't mess up earnings.
All right, so if one more hike's already priced in, so if we hear a hawkish Jay Powell, do you think that'll lead to a sell-off at the back end of the day? We've seen sell-offs at the back end of the day when Powell's been hawkish.
Yes, and these are nail biter days for me. I almost sort of hate watching what happens. He gets on TV, he sort of does what we expect, and then it's all about the speech, right? And then you just see the market pulling back and pulling back and pulling back. But the good news about that is that if you put things in perspective, the economy is strong. That 2.4% GDP, 2% before that, strong consumer continues to spend, good jobs, things like this. If the market pulls back and you take all of that together, it could be a good buying opportunity as well. So you have to sort of keep your wits about you with these things.
And I'll be there to cover it, and we'll see if the market sells off or not. At around 2:30, 3 o'clock, he'll get a bunch of useless questions, and then he'll answer it in a bunch of vague ways. And if he says one little thing that seems a little hawkish, market will sell off. So we'll see what happens when Jay Powell speaks today. Grand scheme of things, it doesn't matter too much, but it's the fun and the excitement and the entertainment of seeing this guy speak and all of us listen to every word he has to say. Now, we got some breaking news, ladies and gentlemen. We've got some breaking news on the market open. Thank you all 400 people for being here. It means the absolute world to me. The breaking news that we have is that I was wondering why Robinhood was down today. Okay, I looked at my stocks and I see everything's up. Everything's pretty much green. Robinhood has this ugly red on it. And I'm just like, why is Robinhood down? And I realized why Robinhood is down. Because apparently Apple is trying to eat their lunch. Apple and Goldman Sachs were planning a stock trading feature for iPhones until the markets turned last year. This just broke an hour ago on CNBC. Apple was exploring the launch of an iPhone feature that would let users buy and sell stocks. The offering would have been in partnership with Goldman Sachs, which obviously has built their credit card with them, or their like cashback card. The iPhone maker decided the timing wasn't right as markets slumped and the company put the plan on pause. Okay, before we get into this article, my top level thoughts on this is that I think this is a horrible idea by Apple because think about what happens when the market goes down, which inevitably it goes down. People attribute negative connotation to the thing they're using when the market goes down. I mean, like it's stupid, but like you don't want to open your Robinhood app when you're down $50,000. Like, and I've been there. I've felt that pain. Like, you don't feel that happy with Robinhood, even though it's not Robinhood's fault, right? The idea that Apple would want, I mean, it makes sense because Apple needs to expand into services, right? That's their growth. They need to have more and more services. Maybe they would take some commission or monthly fee for a Apple Plus stock trading membership. Whatever they would do, they would keep monetizing their users. But I don't know. I don't know if people would enjoy trading via an Apple product and then that Apple product makes them lose money. It's really interesting about it. Apple's conversations with Goldman began during the hype cycle in 2020. Two sources said their work progressed. An Apple investing feature was meant to roll out in 2022. One hypothetical use case pitched by executives involved the ability for iPhone users with extra cash to put money into Apple shares. Wow, that's genius. That's genius right there. Wow. That's genius. Oh my God. That sentence right there. Imagine you have extra cash after you buy a coffee, like 50, 80 cents. And Apple says in one button, hey, do you want to just invest this into Apple, the company? And then they build a whole brand and campaign around financial literacy and don't just buy an iPhone, but invest in the company that's making the iPhone. Oh my God. I wonder if do you think the SEC could say something about that? That seems like cheating, bro. That literally feels like advertising your stock to 2 billion people every time they do a transaction. Oh my gosh. Pretty sure that's illegal. Dude, it feels illegal. It feels too good to be. Could you imagine just like giving a push notification to people to buy your stock? It definitely feels illegal. But like the idea that could happen is like insane. Goldman was going to be essential to Apple's buy now, pay later offering. Stock trading has become another way to keep financial firms to keep customers and drive engagement. Apple was pursuing the same approach. One source said it's a move that could capture the interest of regulators who have scrutinized Apple for its App Store practices. Yeah, this would have regulatory fire all over it. Makes sense they didn't launch it. And it also makes sense they didn't launch it in 2022 when, the markets fell. But that would be interesting. Banks do roundup transactions all the time. Yeah, but isn't it different with Apple? I mean, it's not just roundup transact. It would be, I feel like Apple would do it in such a beautiful, sexy way to get you to invest in their stock. Look, it makes sense at the end of the day. I mean, if any company was going to do this, it should be Apple. Apple's like a staple of the U.S. economy. People should probably invest some extra dollar. And look, the average consumer, there's 423 people here, 432 people here that love investing, including myself. And we take the losses on the chin, but we know at the end of the day that this is the way to secure a financial future. And we're hoping for the long term that our money will be able to grow. The majority of Americans don't do this. The majority of Americans have their money in some account or they don't have any extra disposable income because they don't even know what investing is. And quite frankly, they don't want to know what investing is. They don't care about putting in the time and effort to even learn about what a share buyback is or any of these, things. They don't care about interest rates. So to offer it to the average consumer and get them financially literate, it might expand the overall pie for learning about the stock market. In fact, it might actually add to Robinhood's user base because more people care about it now because Apple is doing your distribution. But it also obviously might hurt them because it's taking away since people will be using Apple over Robinhood. Just gives more ammunition for Apple to be investigated. That is correct. I wish SoFi would do that, to be honest. All I do is put the reward points into SoFi stock once a week. Yeah, it might have some regulation for why they can't do it, but I think it's a great idea. If you're a company and someone uses or buys your product and you have some type of way of interacting with them during the transaction process, the payment process, and you can say, hey, want to like dump the rest into our stock. And if you can do it in a legal way, I think it's a great idea. It encourages more people to even learn what is a stock. Why would I ever invest in Nike or Disney? Can I even invest in these companies at the end of the day? Got Bitcoin roundup with Cash App. It's sweet. Yeah, I know a lot of people do that on Cash App as well. All right, so we talked about Apple. We talked about oil prices. We talked about bonds. We talked about the Fed's fund rate. We talked about what did we talk? We talked about Instacart. We have 15 minutes, ladies and gentlemen, until the market open. Let's talk about why potentially the market has momentum to hit a $4,800 price target by the end of the year. Actually, do we want to see that one? Let's do auto worker strike, and then we'll get to that one. Let's do auto worker strike. Okay, so let's get some coverage on what's going on with the auto worker strike. Obviously, they're still striking. Today's going to be a pivotal day because it seems like they're going to pick more locations. So let's take a look at this and get some updates. Again, the reason why this matters is because this affects the supply and demand of cars. It really affects the supply and demand of used cars. That inflation metric is going down significantly. If it ticks up, then the chances of CPI ticking up, given it's 7% of CPI, is just going to be tougher for that to go down. So let's get an update on what's going on with the strike.
Estimates that the strike could go on for 45 days, which could lead to catastrophic consequences. Joining us right now is Colin Langan, Wells Fargo's automotive and mobility analyst. And Colin, this is different than we had seen in the past. First of all, they're striking at all three at the same time, but they're not striking with every plant. So is this going to be a rolling situation? 45 days, if it lasts that long, what would be catastrophic if they continue at the pace they're doing now, if they ramp it up? How do you kind of get your head around this?
Yeah, I mean, you're absolutely right. This has never been seen before, that we've never seen all three at once, but we've also never seen on a plant by plant basis.
Yo, of course, this guy's name is Colin. He looks like a Colin. He absolutely looks like a Colin Langan. That's absolutely his name.
I mean, right at this point, I mean, they're doing about 10% of production. So this is pretty minor. It's actually kind of an underwhelming start in some ways in terms of all the rhetoric that went into this. I think Phil is probably right that the next wave is probably coming Friday, probably pickup plants. And so you're not cutting out the volumes, but we've estimated in the past full-size pickups could be 2/3 of North America profits. So you're hitting them really, really where it hurts. And I think they want to do here is continue to escalate over the next several weeks. And I think that's what's probably going to happen is you didn't start with the most profitable vehicles, but the next wave will be the most profitable vehicles.
When you say catastrophic, what's it mean for these companies' bottom line if a strike continues for 45 days?
Well, I mean, it's about $2.5 billion for GM and Ford if there's a strike for a month. So we're talking, $3.5 billion-ish, and then similar probably for Stellantis. So it's big dollars. But I think when I talk to investors, the thing that's most important is what is the permanent impact, right? You're going to make up the strike, but we're probably
agree to this to get everybody back. What does that look like for their bottom line?
Yeah, I mean, and that's what's material. I mean, we're talking about the wage demands are $2.5–3 billion from the UAW. The offers that they already have, per year by the end of the contract.
The offers they already have?
The demands that they have. And the offers they have today are over $1 billion, right, that they've actually put out at the 21% wage increase. So, there's a long way to go. We're talking about fixed costs, too. And that's the real pain point for the automakers. Ford's guidance is, 10 to 11 billion, right? So $2 billion potentially on an annual rate by the end of the contract. This is material numbers for these companies, which is why they're fighting so
Even
hard.
though they say
These are very material numbers for these companies. Now, GM did $3.5 billion in net income profits last quarter. So the auto workers are like, hey, buddy, you got $3 billion. Let's get some of that. But GM needs to, make shareholders happy. So it's going to be hard to take hundreds of millions out of those 3.5 billion and give it to the auto workers. And that's why it is material cost for them over the next 5 years.
it's only 7 or 8%. And are you taking into account 32 hours or any of the other things that are, you're not taking those into account?
No, it would be about 6 to 8 billion if you put in all of the massive lists of demands.
So, but you hear Sean Fain say it's a small amount. It's only 6 or 7% of costs. So that's just, what is that? What is that called? Actually, dissembling or duplicitousness or just using the right numbers and saying what you want to make your case?
It's just framing to make his case, right? So at the end of the day, margins in the industry are pretty thin, right? Globally, it's around 7% margins. So 1% here or there is very material. So if you're going from 6% to 8%, you've just cut out a ton of margin.
So you just also made a point that, so they complain, they say, well, the CEOs are making 20 million. So you're talking $6 billion to the company in expenses if they got everything. They're talking about just make the CEO make less money. That you could do that for $15 million, right? It'd give him 5 or so, him or her 5, right? Instead of wouldn't that be better than trying to get 6?
Saying that if they gave the money back, he said, forget it.
How about this?
What this is about.
How about this, Colin? So in the journal today, subsidies for unions will drive labor costs up, making the U.S. uncompetitive. Some of these are subsidies. And if I were an auto worker, turns out in the Inflation Reduction Act, to get the money, the tax credits, you need to pay prevailing wages. And then that means there are wage controls involved in you being able to take the money for the IRA across the board, whether it's green energy or any of these things that we're trying to stimulate production of. That's what we're trying to do. Why wouldn't the auto workers want the same thing? And if you do that across the board with every union worker, wages are going to go up across the board.
I don't disagree. Wages will go up across the board. I mean, to be clear, the 6 to 8 billion is if they got all.
No, I
the
understand.
concessions, so I don't think they're going to get all of them. But you're still talking probably 2.5, 3, probably $1.5, $2 billion, probably a good base.
But we have a difficult. Is the EV transition going to be difficult with competitors like Tesla? Are emission standards that the automakers need to hit by 2030? Are all these things going to be difficult? And if 40% was agreed on, who's going to end up paying that 40%? Do you disagree it's going to be taxpayers?
I mean, I think at the end of the day, I don't think it's going to come directly out of subsidies. I think that the challenge here, you bring up a couple good points, so I'm not sure where to start. But first of all, I think there's questions about where will the jobs go if we do see such a big wage increase.
They're going to have their hand out when the automakers aren't competitive and start having,
It's going to be a tough situation, man. I think, look, so when they're saying $1.2 to $1.3 billion in costs, that's at minimum what the analyst is expecting that Ford, GM, et cetera, Stellantis are going to have to pay. So you're talking at least $1 billion off the top that they're going to have to pay in terms of being able to even get to a negotiation. Now, the auto workers want about $6.5 to $7 billion when you add up membership, benefits, overtime, all that stuff in new negotiations. Ford and GM have come out with $1.2 billion to start the negotiations. So maybe they meet in the middle at $3 or $4 billion to get this thing started. But as of now, it doesn't look like it's likely for there to be a deal to happen anytime soon, especially with what we're seeing with the demands from the auto workers. Kyle says, nice shirt. Kyle, thank you so much. This is usually the Friday shirt on the channel, but we have to break it out for JPOW today. I'll be wearing this during the JPOW FOMC thing. It would be so nice if JPOW would wear like Dan Ives types of shirts during FOMC. Like imagine he wore like a fruity shirt talking about inflation versus his typical suit and tie. Like, I think the market would just feel a little happier seeing JPOW talk about inflation and interest rates wearing a fun shirt versus his like typical demeanor and how upset he usually seems. Let's get an update on Congress shutdown. We got 7 minutes until the market opens. We have Senator Rick Scott expecting Congress will avoid a government shutdown. This is by September 30th. So we have 10 days from now. The market is expecting some type of volatility in regards to a shutdown because of what's going on with negotiations. Scott, a Florida Republican, says House and Senate Republicans are working on plans to fund the government while lowering inflation rates and securing the U.S. border. That's kind of their core update or their core mission. House Republicans failed Tuesday to advance 2 spending bills that would have led to a temporary continuing resolution. He says we should never see a government shutdown again. Scott said that the conservative House Freedom Caucus is working on a plan that will cut what he calls wasteful spending, secure the U.S. border, and lower inflation rates. Members of the House Republican Conference introduced a bill on Sunday to fund the government through October 31st, but that deal did not go through because it failed in the majority Democratic Senate. So they wanted to have a bill that would at least fund us until October 31st. The Democrats did not accept that bill. So now, until we get a bill that can fund us all the way until next year, we're likely not going to have some type of short temporary bill to hold us on until we get into the month of October. That also can be a catalyst for September being bad. I mean, we were talking about it. If Jay Powell messes things up today and he says something hawkish, which, by the way, I don't think he's going to do. I think he's going to be like, look, we're data driven. We think inflation is coming down in certain sectors. It's coming up in certain sectors. We're going to look at the data next month and we're going to make a decision. I think that's what he's going to say. And the market is going to try to interpret every syllable of how he says it to come to a conclusion. But I don't think it's going to be anything that unique. And then on top of that, as long as he doesn't say anything crazy and we find some type of a deal to fund us going into the next month, that would be important. When the government shuts down, that means that the government can't spend money, which one would argue is a good thing given the debt we have. But also there's a ton of government workers that don't get paid, don't have jobs, etc. Now, one of the things is that if people aren't getting paid, that's definitely deflationary. It's just, I don't think we want a lot of government workers not getting paid because on top of that, yeah, it's deflationary, but they also are losing their purchasing power. They're losing money to be able to spend in the economy. One of the big things that I think a lot of people are thinking about right now is how can the market rally if there are pressures on your ability to buy things for the consumer that are coming up very soon. And one of the biggest things is obviously student loans. There will be a $300 to $500 payment every month for student loans, including myself. I have $10,000 and $10,250 in student loans to pay off. You know, it's quite funny because for the past 3 years, I've had this $10K in student loans and I didn't even think about it. I didn't even think of like setting aside a couple hundred a month to be able to pay for it. I can pay it off right now if I wanted to, the entire thing. I don't want to just pay it off in cash. I'd rather, strategically just put a little bit every month and not rack up a ton of interest and be able to invest the other money. But I really wasn't thinking of it the past 3 years. And I'm someone who has the actual 10,000 in cash that can pay it out, right? Like if I wanted to do it. There's other people that probably don't have that 10,000 in cash if they wanted to pay off their student loans, and they probably have a lot more, 40, 50,000. And that's because I paid off my student loans while I was in college, because I had a job. I had a business. I was making money. I remember sending $15,000 to Rutgers when I was on the bus going to Boston in 2020 for my work. And I pressed the button and 15,000 disappeared. I remember doing that. So, I've been paying off my student loans, but I haven't thought about it in the last 3 years. And I think a lot of people haven't thought about it in the last 3 years. And now it's time to pay it off. Jeff says pay that high interest debt. For me, it's not going to be high interest because it's a bachelor's loan. It's not like a doctor's, medical school, anything like that. So it's relatively low. I don't know the exact rate on it yet. I think it's 5% or it might be a little bit lower. I have to check on the website because the website hasn't had any updates. But it's going to be very cheap for me. It's not going to be a lot. So I want to get it paid off by the end of the year. I just don't want to put 10,000 in cash right now and get rid of it because I think there's some opportunities that could be a little better. I believe the interest rate is 4.9. I could be wrong, but I think it's 4.9, but it's not like 7, 8, 10%, 12%. Some people have. The bull case on SoFi is you can refinance your student loans, right? In a much cheaper way. But I don't, people forget SoFi is going after master's degrees. SoFi is not going after bachelors that got like a degree in accounting and have student loans. Like that's not their target market. Because they can't offer a rate that's competitive with what the federal government could give to that kid. They're going after the person who went to medical school for 12 years or a dental school or, a master's degree or an MBA, right? And has to pay $100,000. That's who they're going after because they can refinance those at way cheaper rates than what the federal government could give. And so that's important as well. Do you regret going to college? Absolutely not. I do not regret going to college. I didn't learn anything in college from a business perspective. I learned more on YouTube, quite honestly, than I learned in college. But college was a very important time for my epistemological development, otherwise known as getting laid. So it was very, very important to go to college because it was a great epistemological development for me in terms of the social stratosphere. So look, I enjoyed college. I had a hell of a time, bro. I enjoyed it. I enjoyed and look, the school was all right, but like the social part of that's why like when people say I don't want to go to college, I'm like, all right, cool, but you're not getting the social experience anywhere else other than college, bro. College is that one place where you really get to have fun for those 4 years. And the good thing is my experience in college was I took so many risks and I started so many businesses. So many of them failed. One of them actually worked, which helped me pay for college throughout the 4 years. But I was taking enough risks and getting, C's or B's in my classes to be able to make sure I passed the classes. And the risk taking is what turned me, I think, into the person I am today. So college would not teach me how to grow a YouTube channel. I had to do that shit on my own. In November 2021, I had to make a video and just post it and see what happens and put in the hard work. But college definitely gave me the epistemological development to enjoy the other parts of life outside of, different things that show up. Okay, you guys should be able to see my screen right now. Do you see it? Yes or no? The Wi-Fi is being a little weird. The market's about to open in 10 seconds. Give me 1 sec. Okay, here we go. Yes, you see it. All right. 4, 3, 2, 1. It is 9:30 a.m., September 20th, 2021. Today is the day Jerome Powell speaks. The stock market is now open. Wake your ass up. Here we go. Enphase. Enphase is up a little bit. Obviously, Enphase had a nice day yesterday, being up 5% off TJ Rogers buying some stocks. So we got Enphase right there at 122. Disney at $81. Nvidia at 435. We were talking about it. Nvidia was at the 430s yesterday, or at the 438 range. Now Nvidia at $435. S&P 500 at 443. We've got PayPal at 62.51. GM at $34.09. So GM is up today. Tesla 266 up 0.2%. Ford 1265 up 0.72%. Roblox 2707. It is up. Enphase 121 down just a little bit. Google down just a little bit as we open the market at 138.32. Meta 304 down just a little bit, 0.26%. Apple. Look at that. Apple's inching back towards the $180 range off the increased demand off iPhone 15. So Apple doing well. I can't lie. I'm really excited for my iPhone 15 Pro Max. It's like, I don't get a lot of material things. So I'm like remembering, oh, in a couple weeks, I get a new iPhone. So it'll be my first iPhone in a while. So I am excited to see that happening. Amazon, $138 right now. Rocket Labs, this bad boy fell 13% yesterday. Now it's at $4.52. So Rocket Labs right now at $4.53, down 2.8%, but not down as badly as it was yesterday. Let's go to Robinhood. Obviously, Robinhood was down significantly. I mean, not crazily, but it was definitely down today because Apple decided they wanted to launch their own stock trading platform. Robinhood now down at $10.46. So Robinhood down a little bit from 1060, but not down that aggressively. Apple entering the business, I don't think kills Robinhood, but it definitely makes it harder for Robinhood to do their thing. So we'll see when Apple actually announces it, if it has any material impact. But as of now, Robinhood probably doesn't really have that much competition from Apple. NASDAQ, 13,683, opening up just 5 points higher than it was yesterday, but it is still green. SoFi, 864. So SoFi was 915 for the past couple of days. SoFi now at 864, falling down. It makes sense for SoFi to fall back down to this $8.64 range, but I like that SoFi is in this 860, 850 range because it's really consolidated to this price level. I mean, we haven't seen it go below 8 in a very long time, and really, I think it hit 820, 830, and then it rebounded just a little bit higher. So the next leg up is going to be really good for SoFi, because if it does fall from that next leg up, we know that 864 is pretty good resistance. And look, that's up 100% from the lows at 470 in May. So if you were able to get into that $4 or $5 range, you're probably doing really well on SoFi. So now it's just a question of if we can get to $10 by the end of the year, or maybe even a little bit higher after Q3 earnings. Truist, $28.89. TFC, again, the regionals have continued to fall over the past couple of weeks. The problem is a lot of these regionals, like Truist, are close to 11-year lows. And at some level, when it's paying you a 7% dividend and the price to earnings is grossly undervalued, we're talking about like 80% of what the price to earnings should be. I think investors are looking at the stock like, do we really not want to own this type of a company, especially when we know interest rates are probably going to come down, and then all their quote unquote paper losses are going to be just fine, and they're not going to have that many issues, along with the fact that deposits are not going away. Earlier in the market stream, we showed that deposits are stabilizing at around 17.2 trillion across all commercial banks. So even with money market funds giving you 5%, treasuries giving you 4%, U.S. deposits within commercial banks are not declining as significantly as we thought they were. In fact, they're increasing a little bit. Coinbase at $77. I haven't checked Coinbase in a while. Coinbase at 77 now. It seems like it's been in this range for a bit. It hit a high of 81 a couple of days ago. Let's look at the 1 year on Coinbase. So 114 was the high back in July. Wow. July, we had 114. Goodness. All right. So now it went down to a low of around 68, but still at the 77 range. And also it coincided with Bitcoin going down to, I think, the $25,000 range. Bitcoin right now at 27,000. So Bitcoin doing well, breaking out of that $25,000 range. Airbnb at 143. Palantir, $15.17. So Palantir doing well at 15.17. Stevie Sohn says in the chat, I'm still on an iPhone 8. Yeah, I upgraded from my iPhone 8 Plus a while ago. But see, it's people like you that are stubborn, that like their phones, that Apple is hoping, for the love of God, you upgrade to a new phone. And I think there are definitely people like you that are going to upgrade, but there's other people like Chris, who still has an iPhone X. Bro, Chris has money, okay? I mean, like, Chris has made some money in the stock market this past year, and this man still has an iPhone X. I'm like, bro, I'm not materialistic, but I would at least upgrade my technology, So if an iPhone X is still, able to get him through the past 6 years, and he has enough money to buy a new iPhone, it just lets you know, goes to show you how good the phones are, and how people that have the disposable income to upgrade pretty easily won't do it because it's not worth it, right? And that's been the problem of innovation over the past couple of years with Apple's phones. Netflix under 400. Wow. Haven't seen this in a little bit. Netflix at 395. I'm going to be interested for Netflix's earnings. Earnings seasons is coming up in about 3 weeks. We're getting earnings for all these companies, and all this crazy momentum starts again. If inflation can go down, we can get some good CPI reports in October, and earnings are good. Maybe that is the catalyst for what we see as a new little bit of end of year rally going into December as we end up the year. AMD at 102, SMCI at 248. So some of these AI stocks green, but down a little bit from down decently from their all-time highs, but green for the day. Zion is up, PacWest is up, KeyBank is up. So the regionals are up today. Yesterday was definitely a bloody day in the markets. Today is a little bit more green for most of these companies. Google at 138, Meta at 305, Robinhood at 1048, Amazon at 138, and Enphase at 123. Some people are saying in the chat, Enphase is doing share buybacks right now. I don't know if they're doing share buybacks yet. I don't know if I think we would see a little bit more meaningful stock action if they were doing significant share buybacks, but they might be doing some share buybacks. TJ Rogers definitely bought shares the other day, but I don't know if he's doing a lot of share buybacks. D-Man says, my wife has the 11 and I have the 13. We're most likely going to get the 15 at some point this year. If you call Verizon or AT&T, they will give you $830 for that phone. And so that's why I upgraded, because the phone's $1,200. They gave me $830. I have to pay $370. I was like, and I don't even have to pay the $370 up front. I can pay $10 over 36 months. I was like, this is kind of a no-brainer. Like, to get a new phone, like, this is definitely interesting here. So I think they've definitely given the incentive to upgrade. And again, based on the news we saw today, Apple's launching a potential stock trading platform to compete with Robinhood. They don't care about making margin off the phone anymore. I mean, they care, but they care more about the services. If they could charge you an Apple plus $5 a month membership to get quicker trading access to like your deposits or whatever, features that are influential in terms of the different services they offer, like stock market trading, that's what they want to make money off of, not really itself anymore. Let's get an update on Instacart that went public yesterday. The Instacart founder gave an interview, and let's see what he has to say on their IPO. Instacart, by the way, let me give a quick update on that. Cart shares currently are $32.17, down 5% from yesterday. They are up above the $31 IPO range, so you are still in the money if you got shares allocated at $31. Here's the founder, Apurva Mehta, speaking on Instacart.
Making its Wall Street debut. That stock opened at $42, but then came back down, closing just 12% above its offering price of $30 a share. Joining us right now is Instacart's founder and its largest independent shareholder, Apurva Mehta. And Apurva, first of all, congratulations. I know this has been a very long time coming, more than 11 years in the making. I know that you're a billionaire now on paper, and I want to talk about all of that. But before we get to it, let's go back to the beginning and how you came up with the idea for Instacart. You've been working at Amazon in logistics. You quit your job, you moved to San Francisco, and then what?
Good morning, Becky. Excited to be here. After I quit my job at Amazon, the reason I quit my job at Amazon was because I wanted to become an entrepreneur. And I didn't know what my idea was going to be. And so I moved to San Francisco, and I started about 20 companies. And unfortunately, all of them failed. But one day, I was in my apartment in San Francisco.
Dude, this guy's the typical Silicon Valley story. It's like, I started a ton of shit, it all failed, and then I somehow figured this out. And by the way, he worked his ass off to get this idea even funded, if you know a little bit of his story. So it's definitely well rewarded for him.
When I realized that
by the way, Enphase 125.
I had in my fridge was a bottle of hot sauce. And I love hot sauce, but you can't make it a meal. And so this was an ongoing problem for me. And I figured I couldn't be the only one who's suffering from this problem. This was 2012, and we were ordering everything online except for groceries. And so I decided that I was going to change that. I started coding the first version of the Instacart app, and 3 weeks later, Instacart was born.
When it was born, it was kind of a rough prospect at that point. I think you were doing the deliveries yourself.
That's right. I was the coder. I was the delivery person. I was also the customer service person. I remember one time while answering the phone to help troubleshoot a customer's issue, I had totally forgotten that I had a pot of chicken wings on my stove in my kitchen.
What?
Fast forward 30 minutes later, unfortunately, my kitchen had burnt down and my entire apartment was flooded. So Instacart's early days were very crazy, but
okay, I love this guy's story. He's super funny, but nothing he's saying is gonna get me to buy the stock. I'm sorry, it's just not gonna happen. You guys in the chat, having an only hot sauce in my fridge is an ongoing problem. Oh my god! But okay, there's another clip I have to show after this about the nature of what he's talking about. But let's let him speak for a little bit and then we'll move on. And it has to do with Palantir.
These are just temporary setbacks, and we continue to focus on building a great business.
Okay, let's fast forward to what we see today. The pricing.
Becky was like, yeah, let's move the fuck on from that story and let's talk about the stock.
Came out, it was raised a couple of times, come out at $30. As we mentioned, the stock actually closed up about 12% from that. That values the company, I think, at $12 or $13 billion. That's a big number, but it is far below what it was valued at a couple of years ago when you took your last funding round. At that point, the company was valued at $39 billion. So there have been a lot of questions asked, people wondering, why didn't you go public then? That was about the time that you saw Airbnb.
This is the question. Why didn't you get your investors liquidity then and let retail hold the bag like Airbnb and Uber did? Why are you going public now?
And DoorDash both go public, and both of those IPOs took off.
Well, look, of course, all the markets have completely changed from a couple of years ago. The macro environment has completely changed. And of course, that's also something that we do not control. What we do control is building a strong business with that is very durable. And that's what we've done here. And I'm very happy that the company went public yesterday. And I'm excited to see what the markets think of it in the future.
Apoorva, I'm just asking because there were some investors like Sequoia and others that were a little agitated by what's happened and by the fact that you
just a little agitated, lost $20 billion, just a little agitated.
Didn't go public sooner. I think Michael Moritz from Sequoia was one of the ones who was very agitated by all of that. Why didn't you go public 2 years ago? Why did you decide to wait?
Well, this was in the middle of COVID, and our growth, we had gone from doing about $7-8 billion in sales to doing, to growing over 400% year on year. And this meant that we had to completely reshape our infrastructure. We had to onboard 500,000 people in a matter of just a few months to pick and deliver groceries. And this meant that we didn't have an audit chair at the time. We didn't have a CFO at the time. So I didn't think it was the right idea. And of course, the rest of the board didn't think it was the right idea. And I'm very happy that we went public yesterday. And
yeah, I mean, there you go. He's very happy he's a billionaire, and he should be. But look, it is a fair question because at the end of the day, a lot of investors in the private markets got screwed by Instacart. And it's not really Instacart's fault. It's just, they invested at a horrible time. They invested when the market was giving $100 billion valuation to grocery startups, right? So it's like at that point, it's going to be inevitable. But this guy is a interesting guy, and I agree with him. When you're growing 400% year over year, it's hard to go public, right? Granted, that should be the catalyst to go public, but it's probably hard because you're managing so much growth. It brings up a point. We're going to check on the markets, and then I'm going to get to this clip that kind of follows up on that. A couple of people were speaking at a conference the other day, and their whole argument was that a lot of VCs are funding garbage. They're not funding companies that are actually doing important things. I don't think Instacart is garbage, but it kind of goes to show the way the guy's talking about it. And again, I love his story about, he needs hot sauce, and so he comes up with Instacart. That a lot of the companies that are being created are just not that valuable, and the smartest people in the world are being optimized to create better advertising revenue for Google and Facebook, whereas Palantir and some of these other companies are doing things that are truly transformational. So I want to take a look at that clip after we go through some of these charts, because it just goes to show how important some companies are versus how relatively unimportant other companies are, even though they're big companies and they matter. Robinhood at 1059. So Robinhood's up 1% on the news of Apple. So I guess that news didn't bring it down too much today, with Apple introducing stock tracking. Meta at 307, Google at 138. Again, Enphase doing nicely today. Enphase right now at 124, up 2%. We got to get Enphase back to 130. Might take some time, but hopefully, maybe now they're doing some buybacks. If we're up 2%, the company honestly might be doing some buybacks. I wouldn't take that out of the question if we are up 2%. Volume on Enphase right now, 435,000. Let's go to ARM. ARM's at 54.55. Volume is 1.72 million on ARM, down 1.13%. Tesla volume is 10 million. Look at that. 10 million shares exchanging hands within the first 15 minutes of the market being open. 267 for Tesla. ARC Innovation 42. Palantir also 3.39 million shares being traded. $15.38, up 1.49%. I have a video coming out today reacting to the Eaton presentation. Yesterday, I did a reaction to the the day before that, I did a reaction to the CPKC presentation. As I'm watching the AIP presentations again, I'm getting more bullish that this is like a serious product and a platform that these companies are going to benefit a lot from. NASDAQ 13,720 up at 42 points. SLG $42. Look at SLG go. Just a killer. Pays a great dividend, and it's going up from $20 in March. Amazing. One of those big winners this year. Spotify 166. They're up 4%. Netflix 397. Coinbase 79. So we're seeing a lot of green. Regional banking funds are up. We're seeing a lot of green in the market right now. And it seems like all this green is anticipating the Fed to pause and for our boy J Powell, Duolingo down just a little bit, to be pretty bullish, not bullish, but dovish, not hawkish. If he can live up to the hype, then maybe we maintain this momentum. If not, we will probably be back down. So let's see what happens. And the S&P 500 at 444 as well. Pounds are now 1542. Kevin says we got to get end phase to 80 or 90 so we can all load up. Let's see if that happens. I don't know if that happens. I mean, that's a tough one, 80 or 90, but if Q3, craps the bed, then it would happen. An OnlyFans IPO would be more interesting than the Instacart IPO. Not going to lie, an OnlyFans IPO would definitely be more interesting than an Instacart IPO. I don't know if OnlyFans, I think, did $1 billion in revenue and they paid $5 billion to creators. Yeah, if you put like a 4x multiple on that, you get a $5 billion company, something like that. I think it's possible. If Instacart's only worth $10 billion, could OnlyFans be worth $5 billion and go public? Yeah, that's very possible. That's very possible. Here's one quick stock I want to show you guys that I got from the Wall Street Journal this morning. It's called AMH. Okay, you probably have never heard of this stock before, and it goes back to the real estate thesis that we've been talking about on the Market Open around housing supply. AMH is called American Homes for Rent. Look at this bad boy year to date. 20% year to date. American Homes for Rent. American Homes for Rent is a real estate investment trust based in Las Vegas that invests in single-family rental homes. As of December 31st, 2019, the company owned 52,000 homes in 22 states. Now, generally, this company seems pretty boring, right? Real estate investment trust. They own a bunch of single-family homes. The difference between why it's up 20% and why since 2013, when it went public, it's only up 125%, which is not bad. But, for 10 years to only be up 125%, it's not the most compelling return you could have got in the market. But the reason it's up 20% year to date is because they own a crap ton of houses. The rents on all those houses have gone up, and the property value, which means the assets on their books for those houses, have also gone up because inflation has driven house prices to be insanely higher, like legitimately hundreds of thousands of dollars higher than they should be. So I don't know if this is a company to invest in. I haven't done a lot of due diligence on them, but it's interesting because if you saw the housing kind of market booming, which a lot of people didn't, given they thought it was going to go down because lockdowns, and in fact, it went up during COVID, and invested in some of these real estate plays like an SLG, like a AMH, there was some money to be made in the real estate sector just by finding the right real estate stocks to be able to go into a little bit more. Thankful for Steve and Chris for SLG. Yeah, Ramu, I'm happy you got into SLG. That one was a good one. I got into SLG. It was a good one. It was absolutely a great stock to find at a very cheap price. I remember Steve texting me that day telling me about SLG. I was just like, all right, I'll look into it. And then when you looked at it, you're like, holy crap, this is incredible. Okay, so I want to play that clip now. We talked about the Instacart IPO. We talked about the Instacart CEO talking about the IPO. Here's a clip of it's a 2-minute discussion on what it means for some of these companies in the private markets to get funded. One of the guys is built a space company, so he's on the panel kind of discussing the problem we're having in private markets, and it relates to liquidity and overall technology.
You're quoted to say that 90% of VC-funded companies could go away and there would be no impact in the world.
Yeah, no dog walking apps.
Tell us a little bit. Tell us about that.
I don't know.
But isn't the question knowing the 10% in advance? I mean, that's the hard part, right?
Yeah. No. Okay, so here's like the big thing is America is way too successful, and we did not build the culture of maintaining what made this country successful in the first place. And you've got layers of abstraction of society that allow the smartest people in the world to work on optimizing ad clicks or trading pictures of cats on the fucking internet or whatever. Versus
no to our crypto panel later.
And so the problem with the whole thing is, if you think about what really matters to the world, right, we get to work on cool things like Burning Man or like crazy parties or whatever because we have abstracted layers of society where like we don't all have to fight for food anymore because there is a person that performs this role, there's a person performs this role, and everything mostly works, right?
That's a big point I think people in the West forget about. We get to have the luxuries of society because so many of the dirty things have been fixed via technology and innovation. But where is that going in the future so that we can have the next level of technological innovation?
But if you don't maintain that, you're in real trouble. And basically we have all the smartest people in America working on companies where it's like, hey, you know, you're a SaaS company and you make sales people 2% more efficient. Like, awesome. Like, print money, that's great. But we're starting to see, like, you know, America is in real trouble as geopolitics is going crazy. We've got the RMB system. Maybe the reserve currency of the world's going to change to a multipolar system. Like, this is really fucking serious. And you've got all the smart people who can then affect this. Like, they're not, you know, there are a ton of smart people at Astronus, to give an example. There were thousands of smart people in Google fucking clicking buttons, doing who knows what, you know, like, click the laptop, do a code review, eat the bugs, like whatever. And it's completely insane. And everyone needs to take a good hard look at themselves. And yes, 90% of the companies that get funded, you know, if you fucking deleted them outside the employee base and the investors, the world wouldn't blink. And we're in a really critical period.
I mean, look, he's got a point. He's ultimately got a point about kind of how some of this goes. So the question is, do you attribute that to Instacart? Do you think Instacart is one of those companies where if you deleted it from the world wouldn't blink? I don't know if that's necessarily the case around Instacart, but I do think if you're buying it for the long term, you have to really be confident that like Instacart matters in the world. And in the grand scheme of things, I don't know if grocery shopping matters that much in the world. Now, maybe it could be a phenomenal business over time, especially because the valuation is pretty cheap. It's, you know, trading at 3 times price of sales. It's not as expensive as most tech companies, but is it something that's going to be something that you want to stay with for a long time? All right. I think that's it for me, folks. One last look at the markets. Palantir up 1%, S&P 500, 444. Ford is up, Lucid is up, GM is up, Robinhood is up, Coinbase, Nvidia, SoFi, all these stocks are up. So we got a bunch of green, not a lot of green, but not a large percentage of green in terms of how much they're up, but they are up. They're not red. I will be here 2:20 p.m. Eastern Standard Time, and we will be pre-gaming the Fed decision. Jerome Powell will be speaking, and I'll be here covering what he has to say. Hopefully this green momentum, which is happening because of the expected pause, continues to stay. And if we continue to keep that pause, then we should be all right. Last thing we're doing is word of the day. See, I had it loaded up. You guys are saying you guys are getting good to remind me, but I had it loaded up. So I was ready to do it. I was ready to do it, even though I know you guys reminded me. Word of the day is debuff.
Debuff.
To decrease a character's attributes or abilities within a spell, skill, or item in a video game. The mage cast a powerful spell to debuff the enemy, reducing their strength. The potion she drank debuffed her opponent's defense. Interesting. So this is in the context of a game. Do we have any gamers in the chat? Is this a word you guys use? Decrease a character's attributes or abilities. So if you're playing like Fortnite, you can debuff like a potential character, I guess, and decrease their power. This is a boring word of the day. Do we have another word of the day? Word of the day, Merriam-Webster. Let's see what word of the day Merriam-Webster has. Churlish. Okay, that's a better one.
Churlish.
Churlish. Churlish is a formal word that means irritable and rude. Okay, that's better. Churlish. Let's hope Jerome Powell is not very churlish today. He's definitely going to be irritable. Let's hope he's not rude with how he talks into the market. Yes, we do use that word. Okay, so the gamers love that. Duh, how do you not know debuff? I'm sorry, I don't play video games. I don't know what the Fortnite people and the Call of Duty people, the Modern Warfare people play. That's a game word. Wow, I didn't know. They debugging the MF5 in Call of Duty. Yeah, I didn't know that. All right, so we got some gamers in the chat. Churlish, irritable and rude. Hopefully you are not irritable and rude throughout your day. Hopefully you're not churlish. I'll be back here 2:20 p.m. We'll discuss Jerome Powell. We'll see what happens, and we'll go from there. My bottom line, I think we're not raising rates. I think he'll be relatively neutral, not super dovish, not super hawkish, and we should be okay. I think we survive the day, and the markets will overlook it, and we'll be all right. But it'll be up to Jerome Powell to see what happens. Amit getting churlish because he didn't know debuff. That's a perfect way to use it. That's exactly correct. Thank you, everybody, for being here. I appreciate you, and we'll see you at 2:20 p.m. Eastern Standard Time, and we will discuss what goes on with the future of the stock market with Jerome Powell. Thank you, everybody. I'll see you in a couple hours. Bye-bye.